program is the construction mortgage, which is an interim loan or short-term loan. So when you say interim or short-term, that's all you have to know, that it's a short-term for the time of the construction, okay? They are temporary, it's a temporary loan used to finance the building of a property, okay? And for the construction loan and the improvements, what they do is the appraiser is going to go ahead and look at the property where you're gonna build. They're gonna look at your specifications. They're gonna say, okay, if you build this property, if you build this home on this property, you're gonna have a property that's worth, let's just say $1 million. Well, they're not gonna write you a check for $1 million. They're usually gonna give you 80% of it. And what they're gonna do is they're not gonna write you a check for 800 grand either. They're gonna release it in payments, okay? So on the construction proceeds, the dispersing is what you have to know. How they disperse the construction loan funds. So the dispersing is, some of them will be a fixed disbursement plan. Some of them will be a voucher system. And some of them will be a warrant system. The fixed disbursement plan pays a percentage of the funds at a set time. This is called obligatory advances. Highlight obligatory advances, and they are paid out at various stages of construction. So it could be 5 payments, it could be 4 payments, it's whatever they decide in your note. So for the example in the book, it's 5 different payments, and the first release is a draw of 10% of the loan after the project is 20% complete. When you get to 40% complete, they're gonna release another 20%, and so on and so forth until they've released all the money for the construction loan. Lenders hold on to the final 10% of the proceeds until the lien period for the mechanics lien is done. That way they make sure that all the contractors were paid and that they don't have a contractor's, mechanics lien. Now the voucher system, the contractor or the borrower pays their own bills. And then they submit the bills to the lender for reimbursement. And the last one is the warrant system. And the lender pays the bills to the suppliers and the contractors during the construction. And the borrower makes interest-only payments to the lender on the outstanding amount. So back in the day, all construction loans were exactly like that. They did their construction loan like that, and it was an interim loan, and they had to go out and refinance it. And that's called a takeout loan, okay? So the poor contractors and the builders and the people building their own homes, they had to get the construction loan and then turn around and refinance it, and that cost them money. So a couple people complained, obviously, probably more than a couple, and they started doing construction loans with a rollover to permanent financing. So some construction loans have a rollover period where after they build the home and it's done and the mechanics lien is cleared and they're not gonna have a mechanics lien, they go ahead and just roll it into permanent financing. So the things that you have to remember for construction loans as an MLO is how they're released, which is those 3 types: fixed disbursement plan, voucher, and warrant. And you have to know that it's an interim loan, which is short term. You also have to know that it can roll into permanent financing, or they'll have to do a takeout loan. So that's what you have to know about construction loans